Welcome to Value Investor TV podcast. This is a podcast that helps you grow wealth and become financially independent. That was a great motto right there. This is episode 12, Stock Market Players. My name is Becco, and my partner, Hari Radhakrishnan.
Hello.
I think I pronounced your last name correctly.
You did.
All right, so in this episode, we're going to talk about the stock market players. Okay, in the past 3 episodes, we talked about company going public, what is required for a company to go public. You know, we talked about investment banks. And then the last episode, as investors, how do we access that market? We access it through brokerage firms. We talked about that in the previous episode. Now, in this episode, we want to kind of put everything together and explain to you how the stock market works when you have all these different players working in it, and who are the key players and how they influence the market and what their interest is, their interest alignments. So I just want to quickly outline the players, and then we can dive deep into each one of them quickly. Yep. So the first one is obvious. It's the companies themselves, right? The Walmart or whoever. Just, go to any public traded company. That's what we're talking about here.
Yeah.
So these are companies listed, the publicly traded company. The second player are the investors. So it could be institutional investors. It could be retail investors. We will talk about the differences later. And then the third is investment banks. Like we said, these are the underwriters, but they sometimes have their own prop trading desks as well. They play in this marketplace. And like we talked about in the previous episode, the brokerage accounts, the brokerage firms, they play in this. And lastly, the exchange, the New York Stock Exchange or NASDAQ, or other Toronto Stock Exchange, London Stock Exchange, all the exchanges. So those are the 5 players we outlined to tell you guys more about. So let's dive into the first one. So the company.
Yeah, so you remember when we talked about Hot Dog Inc., right? And we had talked about the debt and equity, which was several episodes ago. But, in essence, they are trading a piece of the company, in exchange for cash, raising cash. So that those shares are issued by somebody either paid money for them or they were given shares, because they were such early, because they invested their own time in making the company what it is, and that was a financial remuneration for their efforts in some other way. So those people own shares, and ideally you would want to see want to invest, as we talked about earlier. The insiders are aligned with the people who are investing. And so if everyone's aligned, then they're going to do what's best for the share price, and because they also benefit when the share price goes up. So these are the people who work for the company. They're on the board. They're affiliated with the company in some in some way, and they typically don't do a lot when it comes to the actual volume of transactions, because they may own a percentage of the shares. Sometimes it may be small. Sometimes it may be large. But they're not typically, companies don't typically buy and sell their shares on a daily basis. I certainly hope they don't do that.
That would be crazy.
But yeah, when a company does that, they may also issue shares to raise money, and we call that a secondary offering, which we kind of talked about after the IPO. So, they may have blocks of shares that they sell later, through, and that may go through an investment bank or something like that.
Yeah. So that's company. Let's move on to the next one. Investors. That's you and I and many others out there, as well as institutional capital.
Yeah.
So let's jump into let's do institutional first.
Yeah. So I want to make it very clear. All of these different groups, that are market players, they are still owners of the business, right? And they own the business because they own shares, right? So whatever label is applied to them, they're not any different from you and I who also own shares, right? So when we talk about institutional investors, this is an enormous industry that is made up of people in mutual funds. So these are people who invest on your behalf. So you buy shares in the mutual fund, and they use that cash to buy shares in individual companies. Sometimes that is based on a philosophy, like we only invest in value stocks. Sometimes we only buy growth stocks.
Industry specific.
Industry specific mutual funds. Sometimes it's country specific funds. And they run an enormous gambit of this. So the mutual fund industry was very popular 20 or 30 years ago, and that has kind of shifted away to this, robo-advisor slash
ETFs.
ETFs. There's a lot of differences, and they all essentially charge you some fees for managing your fund. That fee may be associated with how much money, if you give them $100, they take $2 of that. Regardless of how they perform, they take that money. Some of them are called, they call them hedge funds, and they buy stocks in certain companies, and they take a commission of assets under management of 1 or 2%, but they also take a percentage of the profits they earn you or don't earn you in many cases for that. So inside this umbrella term of institutional investors, there's also a ton of other things: endowment funds, pension funds. So, for example, Rice University has a almost $6 billion endowment fund, and a third of that is publicly traded companies. And they may, these publicly traded companies. The institutional investors may invest in other institutional investors. They call these fund of funds, and all of this stuff. Some of this is, when you start breaking it down and looking at it, it is pretty insane where people put their money and who owns what. To start looking at it. Here in Houston, Rice University actually owns a huge percentage of the real estate around the university, and they make a lot of money off of renting that out. So all of that falls under, these different categories. And so we talked about that. There's also private equity firms, which, they may borrow money, or they may, they run these funds with money that they already have, and they buy out companies, or they buy large stakes in companies so that they can manage the company, the way that they want to. We talked a little bit about that, about board of directors and, those kind of things. So, I think it's important to understand there are professional money managers in this. There are, there are robo-advisors, there are mutual funds. And I think the other one that we haven't talked about a lot, but it is very important, is called index funds. And so those are essentially, they have to attach themselves to a specific index. So the S&P 500, the Dow Jones, and so they buy and sell based on very specific criteria of how those indexes are weighted, and they fall into that institutional group. So one of the biggest institutional investors is called BlackRock. And they're investing money. I mean, they have like some crazy trillions of dollars.
Trillions. Asset under management, it's like in the trillions.
Yeah, and that's
insane.
And they collect like 2% of all of the assets under management. And so even though they're managing trillions of dollars, the amount of money that they make is based off of the assets under management. It's not on a percentage of how well they do or any of that kind of thing. As far as, they may have some funds in there that operate that way.
Yeah.
So I think it's important, as just an aside, when we talk about these different players, the private equity firms, the hedge funds, the mutual funds, and all this, they have this air about them of telling you that we're a professional money manager. You're incapable of doing, managing this yourself. You're too busy, et cetera, et cetera, et cetera. Give us the money so that we can manage it for you. And, when you start, going down that, and you then look at their incentive structure, right? If they were really good at what they did, what they would say is, I will only make money when you make money, and I will take a percentage of the profits that I generate for you, and no fees when I do assets under management. And if they did that, most of them would be bankrupt right now. And that's why they use assets under management, because they are incentivized very differently from the way you would be incentivized if you were managing your own money, right? And I think that's a very, very important concept, because if their goal is to make money, which is every business's goal in the history of the planet, then they're going to spend all of their effort growing their assets under management, regardless of how they get there. And the easiest way for them to do that is to go and get new investors to put money into their fund, right? And so when you talk to these, or when you see these people, you can look at their actual performance over time. 99% of them, over a 10-year period, trail the index. So you're, as an investor, if you choose not to manage your own money, the best place to park your money is in an index fund, right? Because these guys don't transact, like the hedge funds and all that, and they're not focused on assets under management. They're focused on, our task is basically just follow the index,
right.
And the index is proven to, beat that is the market. Most people can't beat it.
Yeah. Just want to quickly recap what we talked about there. So right off the bat, you talked about how everyone who is playing in this market, in this place, and who owns shares of the company, they are labeled as investors, but they really are owners as well.
Yep.
As holders of the shares of a publicly traded company. So you talked about that, and then from there we talked about institutional investors and different incentive alignments and different players within institutional money, the professional money managing class, and then you have the kind of the capital allocating kind of the just they're sitting on a pile of cash. They need to deploy it in all these different places, such as Rice University Endowment. They have close to $6 billion. And this is something that I found. Sovereign welfare funds, sovereign wealth funds, Norway has them, America has them, China has them, every major country has them.
Yep.
Norway, for example, they have $1 trillion in endowment. So they need to allocate it in different places to ensure the sovereignty of the nation as they move forward. And so they will distribute money. So let's say Norway, Sovereign Wealth Fund, will distribute money to professional money managers in Wall Street, such as Fidelity or whoever it may be. They'll distribute it to them and say, hey, please manage 30% of our money. They'll give that to them.
Yep.
And they'll go out to the public marketplace and buy a whole bunch of stuff. And so that also creates kind of investor money managing kind of relationship, because they now have investors to report to,
right?
And so there's a lot of structural incentive alignment there, as well as the fee structures that you talked about, the 22 fees of a lot of hedge funds and mutual funds, and how that's how that sometimes may not be most conducive to profit making.
Yeah, I think that concept is very important, because in almost every industry, right, the professional is somebody who is trained to do certain things, and their incentives are usually aligned with yours, right? Your, physician, is not, it is incentivized to make you well, because otherwise they, first of all, most physicians aren't scumbags, and they don't, want you to get sick, right? It's not like, everybody says, well, they just make me sicker so that they can have a lifelong patient. That's not how it, typically works, right? But you go to a professional, you go to a lawyer when you have legal trouble, you go to that. It is natural for us to think that if somebody is a professional in their area, they perform a service for us that, better than somebody who's an amateur. The stock market is not that way, because a lot of the times when you put too much money into one place, it becomes very difficult for them to deploy capital meaningfully, right? And so what happens is, the larger you get this diseconomy of scale, which means that you can't deploy your money effectively, so you have to buy things that you wouldn't otherwise buy. Mm-hmm. And effectively what happens is they make less money for you because they have more money. So that concept is really important to understand, is they have structural problems that limit how they can, perform. And so, and as they get bigger, they have fewer and fewer places. You know, if I had a $10 billion company or, you know, mutual fund, I can only invest in up, you know, a maximum of 10% in any individual company, you know, is one of the rules. Then that means that I have to invest, you know, $10 billion, you know, or $1 billion at most in one individual company. Well, if I can only find 3 good companies, then I'm not going to, you know, as a mutual fund, they typically fully invest every dollar that they have. And so what it does is it incentivizes them, because if they don't do well, then you pull your money out of that mutual fund, put it somewhere else.
Right.
So it kind of enforces this short-term kind of thinking, and it enforces this idea that I have to do well every quarter. And if you start thinking about this from a longer-term perspective and think about it from, I'm an investor, I'm willing to, you know, endure, you know, some ugliness for 6 months, a year, 2 years, even 3 years, because the light at the end of the tunnel is a significant rate of return for me. That mentality is very different than what the institutional investor has.
Yeah.
Because they're beholden to the sovereign wealth funds, the
endowment funds,
other endowment funds to hit at, you know, institutional investors, and so that creates a different incentive structure, right? And so, you know, we're going to talk a lot about this in the next series of episodes. You know, after we get through some financial statements and things like that. But I think it's very important to understand that institutional investors don't necessarily have your best interest in mind, because they are terrified that you're going to move your money somewhere else. And when that happens, they have to sell, you know, shares. So they are heavily focused on short-term performance. And I think this illustrates something, too, that, you know, in the 50s, the entire market was basically retail investors. That's you and me, retail investors. And then what happened was they started selling mutual funds because they said, well, a professional can handle your money better than you can. And as people moved that money away from retail to institutional, what ended up happening was it became more short-term thinking. You know, the average holding term for, you know, stocks in the 40s and 50s and 60s was measured in years. Now that's measured in months, because there's this short-term and, you know, mentality. Institutional investors are, you know, they have, you know, various metrics, but one of those is the turnover of how many shares do they, do, and sometimes they're turning over their portfolio 3 and 4 times. So that means that, you know, the holding period for some of these stocks is 2 or 3 months.
Yeah. Maybe can you touch on the famous saying about, like, IBM? If you were to buy IBM, you'd never get fired. I think that's also important to mention.
Yeah.
In addition to the structural limitations.
Right.
Intra-company dynamic.
Yeah.
Can you talk about that?
Yeah. So, you know, there's this concept is called the institutional imperative, right? And, you know, one of the things that they say is no one ever got fired for buying IBM, right? And that actually applied, you know, if you were a customer of IBM, but it also applied to the stock market. So in, you know, the 60s and 70s, there was this list of companies called the Nifty 50. And the Nifty 50 basically was a list of companies that you as an investor should buy at any price because they have an unlimited growth runway, right? And that was kind of the concept, was it doesn't matter what price you pay because they're great businesses. And so a lot of people just said, well, we're buying the Nifty 50. And, you know, that was how the institutional funds worked, was these are very large companies. They're not going to go bad. They're not going to, you know, any of that stuff. And so a lot of those companies that were on that list were companies that all of these institutional investors held. And so what you would see is a lot of, you know, very little difference between these different institutional funds, because they were all basically buying the same thing, largely because everybody else was buying that. Because if you didn't buy IBM and you bought and then you did poorly, you can just say, then you would be fired because you know, people would say, why did you pick that? But if you bought what everyone else bought and it went down, you can say, well, that's just the market. Yeah. And so, you know, that kind of ridiculousness, you know, in thinking is, it's a purely psychological, you know, effect, and it affects everybody. You know, people are not making decisions based on rational behavior. as we've mentioned so many times in this podcast up to this date, look at their incentives, right? And if their incentive is, I'm making a crap load of money managing this, this fund, and all I have to do is go and listen to what everybody else is buying and buy that, and I won't get fired, and I'll make millions of dollars a year managing this fund. Well, hell yeah, I'm going to do that, right?
Of course, yeah.
And that concept is why, one of the best books on understanding that institutional imperative is Peter Lynch wrote a book. He actually wrote two books, One Up on Wall Street and Beat the Street. And those two books actually, ran the Fidelity Magellan Fund in the 70s and through 1990. So for that 13-year period, he absolutely beat the crap out of the market. And he just kind of illustrated look, I didn't listen to what anybody else did. I didn't buy the I think the Nifty 50 as a concept had kind of faded away by then, but he basically bought what was good businesses that were considered growth stocks at the time, but he paid he paid very much attention to the value of them as well, and he beat the market by doing that. And he really illustrates how a lot of the colleagues that he had in the mutual fund industry did not adhere to those principles. And, they just bought what everybody else bought. And that mentality led to very poor returns.
Right. So you talk about Nifty 50, you talk about IBM. Yeah. And, I think it's also important to point out that this is happening right now today. Yeah. Right? So you have FANG stocks being talked about. You have Tesla being thrown out there. Everyone owns owns FANG stock now.
Yeah. Yeah.
So it's happening right now. It's not a thing of the past.
No, and that typically that happens when there's a strong bull market and people push up the prices of certain stocks very high, and they far exceed their underlying intrinsic value. And that's not to say that these FANG stocks aren't good companies, but you wouldn't pay an unlimited price for anything, right? Toyota Corolla makes a good car, right? It makes a very good car, but I wouldn't pay $300,000 for a Toyota Corolla, right? So, Amazon is a good company, but I wouldn't pay $1 million per share for that, that stock, because, then that company would be worth more than the entire capital in the world, right? So, this concept there has to be an anchor to every decision, right? That is what the essence of value investing is I'm anchoring to a very specific target, which is a price. And if I'm well below that, that margin of safety below that price, then I'll buy it. Mm-hmm. And when you see the FANG stocks, the Nifty 50, that institutional mindset of promote these individual stocks because they have unlimited runway and all that stuff, it works. And it may work for 2, 3, 4 years, but what will end up happening is when the piper, somebody has to pay the piper at some point, and that's when the value of those companies gets wiped out very quickly. Yeah.
So those are really important points when you and I are approaching the marketplace as individual value investors.
Yep.
Really, really important to note. Let me quickly just kind of summarize really quick.
Yeah.
Kind of the high level perspective. Inside investors, we broke it down into two: retail investors versus institutional investors. Within institutional investors, we talked about different incentive structures involved.
Yep.
Right. We talked about Nifty 50, the FANG stocks. When people are managing millions of dollars and they're making millions of dollars in salary, they don't have to go out of their way. They can just follow the crowd.
Right.
And that is the peril of institutional investing. And we need to be really mindful of that. And we talked about different types of money managers, the hedge funds, the mutual funds, and then the index fund, and the rise of ETFs. We talked about those. And then aside from that, the other part of the investors group, retail investors like you and I,
yep,
and the kind of mindset we need to have to tackle this marketplace. And the false notion that the professional money managing class knows they're omnipotent, they can grow your wealth, double your money, triple your money. That false notion has to be corrected.
Yeah.
And as investors, as value investors, retail investors, we need to be really mindful of those kind of institutional perils and institutional interest alignments.
Yep.
They're not aligned with ours. Okay, let's move on to the next one. Investment banks.
So, we talked about them a little bit with IPOs. They underwrite the shares of companies, and they may have clients that they, make recommendations to buy and sell stock. They can account for a significant amount of volume because they move in and out of shares and make recommendations, and they employ people who are professional traders, right? And so they see what they perceive as imbalances, or and they make these things called hedge trades where they buy one thing in some area and sell something in another area.
Mm-hmm.
So for the most part, as a day-to-day person, as a retail investor, as a value investor, they don't really have a whole lot to teach you, as far as what to buy or sell, right? I mean, that, as we've talked about before, it's about the fundamental analysis of the company and what does the business do, and understanding the business dictates whether or not this is a good investment.
Right.
And so, I don't have a whole lot to add to that. I mean, I think, other than, what we've already kind of talked about.
Yeah. I actually do want to add analyst.
Yeah.
Kind of falls into investment banks and how their interest.
Right.
In, analysts are pretty important in the stock market. Or not, they play a significant part in it. They get on the conference calls and ask all these questions. They have ratings, and depending on the ratings, stock price moves up and down quite a bit. So tell us about that and how their incentive structures as an employee of investment banks might not be aligned with yours as outside investors.
Yeah, and they're not isolated just to investment banks. They may actually be in brokerage firms too. But just to kind of talk to that. An analyst it's very interesting to see what kind of recommendations they make, because largely almost every recommendation that they make is not very negative, right? For the most part, they're saying buy, sell, buy, strong buy, and hold. And, very rarely do they issue sell ratings, partly because they don't want to issue that because they don't want to piss off companies. Because if they make a sell rating, or they aren't promoting a company, then that company may not do business with them as an analyst. And so the analysts use this as kind of the tip of the spear to kind of get business through the door, and so their incentives are not very much aligned with telling you the truth or saying anything. And when you listen to the analysts on some of their calls, they try and do the financial modeling and all of this stuff. And to be honest with you, it's, they try and get very precise on something that is not accurate, right? You just can't be very accurate with, predicting the future, right? I mean, that if they did, then, weathermen would be the greatest, the stock market, predictors of all time. It's just, the future is uncertain. And so part of this is just understanding what you're doing is not trying to be precise necessarily, because you can be, that's kind of what analysts are saying, is they're going to say next year the company is going to earn this, and then the year after it's going to earn that. I mean, they're wrong far more often, than they're right. And, so trying to put a precise number on this and all that stuff, you're never going to get close.
Yeah.
So, analysts typically, are doing this largely to be, I'm following a stock, and then, they have their own clients that they're, and they may do things that's a little bit shady, where they tell people, hey, I'm going to put a sell rating on this company, sell now before I do it. And then you can make money, that way. And so, they're adhering to a different structure and a different, they're where their money is aligned, right? And so following the incentives tells you, they're not a good place to look for recommendations.
Yeah. And I think that last point, not a good place to look for recommendation. In fact, as beginners, we tend to gravitate towards these earnings report, or these analyst reports out there, because they're relevant, or not relevant, but they're prevalent. And you can just pick them up and see, Tesla is a buy, I'm going to go buy Tesla, or Microsoft is a buy, I'm going to go buy Microsoft.
Yep.
And so you got to be very wary of their incentives and how they fit in this marketplace.
Yeah, and just to give you a real quick example, in 2000, Cisco was, trading at like $170 or some. It was very large, multiple to what their cash flow and things like that. And when the dot-com bubble burst, right before that, I want to say 100 plus analysts had a strong buy or buy on the Cisco stock, and the stock lost 80% of its value in a 3-month period. And I mean, if you followed the analysts, you would their incentive is not to tell you what's going to happen correctly, right? I mean, they're strong buy, we want Cisco's business, strong buy. That doesn't help you, right? Just looking at this, you can find a lot of examples where they're just flat out wrong, and they tell you to do stuff that has no thing. So I would always say anything that you do, you're going to have to do the work yourself. And if you do that, you will benefit, and learn, from your experience. So don't follow what other people say. Just, do the work yourself.
Yeah. Okay, and let's move on to the fourth player in this marketplace, broker. I mean, we talked about that in the last episode. Do you have anything to add there?
Not really. I think, look at the last, talk. I mean, they kind of do some stuff to help manipulate the market, not manipulate, but support the market in terms of making sure there's enough liquidity, which is trading volume, to make sure there's bids and asks. And so they participate in that, because obviously they're placing transactions for you. They may bulk, order transactions just to reduce their costs and things like that too. So, they participate in that way.
Yeah. Okay, and then lastly, let's talk about the exchange. New York Stock Exchange, NASDAQ, those are two iconic American exchanges here in the U.S. What do they do, Ari?
So they actually provide the listing service so that you can, they're basically the place where people come together. All these, providers come together to buy and sell. They support the companies in listing their services. And, they actually also provide some level of requirements in order to be on their exchange. You have to have so much trading volume. You have to have so much in terms of, and so they're a necessary part of the place, because if you want to buy a stock, you have to go through an exchange, and the exchange is where these various market makers, who are people who actually ensure that there's enough liquidity for trading during hours, and incidentally, that's also why after hours you'll see very big changes in the price, is that these market makers aren't there to make sure that the trade transactions are regular and and safe.
Yeah.
So there isn't big changes in your in the stock swing in the price.
Right. I guess. Yeah. So that was exchange. I just thought of something. One thing that we could add to this list is probably regulators.
Yeah.
They kind of play a backstage role, but they do play a role in this marketplace.
Sure. They are part of that process, but they don't necessarily exchange, participate in buying and selling.
Right.
But the SEC and, other regulatory bodies do have they kind of set the rules for how the trading can occur, so it's regular and regulated.
Yeah. So when I go through this, I just want to kind of tell people what I think about it. The marketplace. So I try to start a small side gig. I try to sell stuff online a year ago, 2 years ago, and going through that process, you realize how hard it is to actually start something up and make it profitable and sustainable for long term. It's a lot of work, and obviously I did it myself, so I could have shared some of the burdens. But you realize, oh man, actually, erecting a business and running it is a lot of work. And if you look at this, you got the company, investor, investment bank, the analyst, brokers, exchange, the regulators. It's amazing how everything is set up for you.
Yeah.
All you have to do is open up the brokerage account and really just put some money in, and you can ride the wave of American growth, or any
Yeah.
growth for that matter. You can just ride this wave, and everything is set up for you. Whereas if you were to start your own business, think how hard it is to get it from, funding, putting the team together, et cetera, growing. Yeah, it's a
Yeah.
lot of work.
Yeah.
Whereas this is really, just step back and think about this. Like, this is really fantastic. Like, it's just stepping back and thinking about it, this is like wild to me. Like, that anyone can access the market and really just the tailwind of, Warren Buffett talks about this all the time, right? That tailwind of American business, the force that it brings, you can just ride that wave.
Yeah, and you can own a piece of these businesses, as many or as few businesses as you want,
Yeah.
and you benefit when they benefit. And I mean, to me, I think it's very, as an American, I think it's very patriotic to actually, because you're participating in, America and supporting that, the economic growth, and and you're benefiting from, that growth as well. So, you have the option of doing that by buying into the market or staying away from it, right? And it's at your own detriment, I would argue, to stay away. You're going to lose if you don't.
Yeah, it is amazing. It is amazing that there's all this infrastructure already in place for you to just play in. I mean, that's pretty astounding to
Yep.
me. Okay, let's look at the next topic, which is different ways to invest in the marketplace.
Yeah.
A lot of times you'll hear, oh, we are long only, or we're short only, or we're hybrid. We do both short and long. What are those terms? Let's define them. So what is long platform?
So long is basically you're buying. So they say, you go long on a stock, or you're a long only stockholder, or that kind of thing, is essentially meaning that you're buying the securities to own. It doesn't mean necessarily that it used to mean that you're holding it for a long period of time, but hence the term long. But it doesn't necessarily mean that. You're essentially just saying, I'm buying it with the intent that the stock price will go up, and then I will sell it. The buy low, sell high kind of mentality. And the flip side is short.
Mm-hmm.
So selling something short is essentially just basically, I'm borrowing shares from somebody else via my broker, selling those shares in the market, and then hoping that the stock price will go down, and then I buy back those shares and then give those shares back to the original borrower.
So that transaction is a little bit complicated. Can you reiterate that one more time?
Yeah, so the short selling is essentially just borrowing shares from somebody in your brokerage house, right? When you borrow those shares, you sell them in the open market, and then expecting that the price will go down. And then if the price does go down or doesn't go down, you buy back those shares at some point, and then return the shares back to the original. It'll go back to the broker. The broker will put them. Now, in my brokerage account, it doesn't tell me that. It still says that I own those shares, right? So when I'm borrowing, they're not actually borrowing from me as an individual necessarily. They're borrowing it from the broker's pool of the shares that are owned. And so when those shares are shorted and sold, you still have it in your account. And if you had to sell them, you can. It's not like because they're borrowed from you that you can't, like a physical item. So, but when you go short, you're essentially hoping that the price of a stock will go down. Now, as an aside to all of this, there are some value investors who buy long and sell short, and kind of do this hedge fund. One of those is David Einhorn. In my mind, if you're buying something to hold, there's potentially an unlimited upside, right? That the stock could just keep going up. If you're selling something short, your only benefit is, only hope is that it goes down, and it can only go down. You have a limited upside of 100% return, right? Which is the price of the stock to going to zero, and then getting all of that money back. So to me, selling something short, first of all, I don't think that way. I can see that companies aren't doing well, but I don't like piling in on the, on that, because sometimes as people who have invested and short sell Tesla have found, even though the company doesn't make money and things like that, the stock price may go up. Irrationality may far exceed your ability to be solvent, and in that case. And so when you see those kind of things, so being wary of that. But short selling does add it provides liquidity in the market when people are trying to sell that there isn't enough sellers. They're actually borrowing shares and selling, allows there some transaction volume to exist. So it does make it, to be honest with you, I like short sellers because if they sell something short, they may lower the price for me to buy it at a lower price.
Mm-hmm.
So that's part of this market, and a lot of the institutional investors and all this have this in their bag as tools. They can buy long and sell short.
Yeah. So that was long and short, different ways to play in the market. There's also another way. Not a lot of value investors actually do this, which we're going to talk about here in a bit, but some do. Some actually do play in this, and that's options. So there are two different types of options, puts and calls. But just tell us what options is overall, and tell us two different types.
Yeah, so I think this is something that we can talk a lot more about. We'll just kind of mention it here, and then we'll talk about the implications later. So options are really it's a contract that you go into with another individual, and the two types, there's a call option and put option. The call option is essentially the right, but not the obligation to buy a stock before a certain date, which is called the expiration date, if it goes above a certain price. So in essence, if I have a call option to buy a stock at $15 and it's currently trading at $10, that option will expire if it before the expiration date. If it doesn't ever hit $15, I don't make any money, right? So, I can't buy the stock price at $15.
You can't execute the
I
trade.
can't execute the option. The flip side to that is puts, which is it gives the owner the right but not the obligation to sell at a specified price, which is also called the stock price, the strike price, before the exercise date. And so it's, in essence, you're betting that the stock is going to go down, and if it does, then you want to kind of limit your losses, or you may actually benefit financially from that, by protecting yourself. So these two things, these are additional things that occur on top of the stock, typical stock market volume of buying and holding. So it's not just I have to buy shares. I can buy contracts that allow me to do certain things with those shares. Right. So what does this all mean? In that these are just some of the components of the market itself, and these are just kind of introductory topics. We can go into further detail about this, but I think we're there's a lot to digest in this episode, so I would say we'll save that for a later date.
Yeah, that sounds good. So let's just do a quick recap of the episode. This was the stock market players. Who is out there in the marketplace? Company, obviously, investors, different types of investors we talked about, institutional capital as well as retail money, and investment banks / analysts, and then we talked about brokers and exchange, as well as we touched on the last point, which is regulators. We added that at the last bit there.
Yep.
And then different ways to play in the marketplace, long and short. And then we also talked about the options as a way to play in the marketplace. So that is it, you guys. Stock market players. It was interesting and exciting to talk about it. So I hope you enjoyed it. And if you did, please leave us comments in the comment section and subscribe to our channel. Be it on YouTube. I know a lot of you guys are listening to us on podcast. So please tell your friends that this podcast is awesome. All right. I'll see you guys on the next episode. Thank you.
Thanks.